A new week is here and it's time for a fresh edition of Hollenbeck Unleashed with Dr. Frank Hollenbeck. So thank you for joining me once again, Dr. Frank. We're going to talk about the ECB. So the ECB have lent billions of euros to banks in hope that they're going to buy sovereign debt. But what's the implications on the sovereign debt market?
What is happening in Europe is that the ECB is throwing money at banks, hoping that banks will buy European debt. The way it's being done is that it's lowering short-term interest rates, but long-term interest rates are relatively high. It's relatively easy to borrow at 1% and purchase a 3-month Portuguese bond, which we just saw. They just issued a billion euros. It's easy to purchase a 3-month Portuguese bond if you assume Portugal is not going to default. But we have to look at what's happening in terms of incentives. What incentive are we putting into the system? The incentive we're putting into the system is that governments are going to want to borrow more and more short term, because borrowing at 7% for Italy is just not long term feasible. So what's going to happen is they're going to be borrowing more and more short term. So if this policy continues, and let's say they continue to flood the market with easy money, and what's going to happen is governments are the average maturity of their debt is going to decline. What you have to understand is that the shorter is your debt maturity, the more difficult it is to default the second way. In other words, default by printing money, by reducing the real value of your debt. Because what happens is that you have to pay back in 3 months the amount that you borrowed, and when you borrow again, you're going to have to pay an interest rate which includes an inflation premium. Okay, so one of the things that's happening is that I think it's going to reduce the average duration of debt, and this is going to put governments in even riskier situation because of the relatively short maturity of their debt.
So it's easy to criticise the ECB, what they're doing, saying that it's not helping the long-term situation of these countries. But so what is the solution? How do you bring down the yields in the long term?
Well, the thing is, the real solution would be to, given the current level of debt that we have, the solution would be to grow our way out. If we could grow the economy, then we could grow our way out of this problem. That doesn't look like it's going to be possible. We see that we're going to be likely to have a recession in 2012, unlikely to have any growth in the next 5 years. There was a very good study done by Rogoff, who basically showed that once you go above 90% debt to GDP ratio, you significantly reduce your growth. So if we're not going to grow our way out of the problem, and usually you default directly when you can't print your own money, then we basically only have one option left. In other words, the future, we really only have one option, which is to monetize the debt. So we then have a decision to make. Are we going to make all the European citizens pay, okay, to monetize this debt, in terms of should the Finns pay, should the Germans pay, okay? Or should the governments go off on their own currency and then inflate their own currency so that the Italian people pay for the excesses of the Italian government, the Spanish people pay for the excesses of the Spanish government, and the Greeks pay for the excesses of the Greek government. What is the ultimate choice that we have? Are we going to require all Europeans to pay, or should we just let individual countries who've been excessive in their debt levels pay for the price of reducing the level of the debt?
But isn't it the European Union, isn't it? We can't suddenly just say, okay, Italy, that's your own problem, Greece, that's your own problem. Everyone's in this together, surely.
Well, UK is part of the European Union, but they don't really care about Italian debt because they're not part of the euro. We have to distinguish between being part of the European Union and being part of the euro. I think also I need to point out that a lot of people are saying if Greece leaves the euro, or Spain leaves the euro, if Italy leaves the euro, it's going to be catastrophic. We've had countries go off and change their currencies, and it hasn't created a disaster. I'll give you several examples. France, I think it was 1960, where they went from the old franc to the new franc, and there was hardly a hiccup in growth. Germany, after World War II, went on to a new currency, and actually was beneficial in the sense that by going on to a new currency, which was a Deutschmark, okay, they were able to actually eliminate capital controls, and Germany had experienced the phenomenal growth they saw during the 1950s.
Let's finish off. Why don't we just let Greece default? Because again, there's been talks today of increasing the haircuts that banks have to take. Why don't we just let Greece default?
Well, Greece is in a difficult situation. You have to understand they're trying to reduce the debt from 200 billion, the private sector debt, from 200 billion to 100 billion. And the problems with that is 36 billion of those are due this year. So if you're a debt holder and you're supposed to get paid back by Greece this year, they're telling you, oh, you have to take a significant haircut. And not only that, you have to wait maybe 20 or 30 years before you get your money back. So there's really, for those holding that particular debt, there's a relatively little incentive for them to do that. Also, we all have banks who are holding credit default swaps. And credit default swap is essentially insurance. If Greece defaults, basically you've paid insurance and you get the principal or possibly interest on this particular debt. So the problem right now we have is the private creditors. There's some segments of those private creditors who probably don't have a great incentive for this haircut to occur. The reason, let's be honest, the private creditors are willing to take this voluntary haircut. It's a bit like if I put a gun to your head, you're going to voluntarily give me your wallet, okay? The private debt holders are basically saying, well, we have a choice. We either lose 50% of the nominal value now, or we lose basically all of it tomorrow, because you have to understand that the private creditors are kind of like last in line. The IMF gets paid first, and the ECB gets paid first, because ECB is holding 75 billion of Greek debt.
Okay, well, thank you very much, Frank. Dr. Frank Hollenbeck dispensing his unique points of view once again. The next edition of Hollenbeck Unleashed will be available on Wednesday, but for now, goodbye.